Thinking of buying a new car and wondering how to finance it? One of your options is personal contract plans, often referred to as PCP. With personal contract plans, your monthly payments can be lower than a hire purchase plan or personal loan. This is because you are repaying the difference between the cost of your car and its predicted value at the end of the agreement, plus interest and fees, of course. The predicted value is calculated and guaranteed by the finance company, which is why it's known as the Guaranteed Future Value, or GFV. At the end of the finance term, which can usually be anything from 2 to 4 years, you'll have 3 choices. 1. Return the car to the finance company. 2. Keep the car by buying it outright for the amount of the Guaranteed Future Value. Or 3. Trade the car in to buy a new one. The first option, returning the car, costs nothing unless you've exceeded your expected mileage, which you will have agreed with your dealer at the start. Or if it's in poor condition, either of which could mean you'll have to pay an excess charge. If you choose the second option, to keep the vehicle, then you'll be required to buy it outright by paying the amount of the Guaranteed Future Value as a final payment. Lastly, you could trade in your vehicle, so the finance can be paid off and the equity can be used as a deposit to buy a new vehicle. Because personal contract plans and the GFV are more complex than some other forms of finance, it is worth considering some of their features in a little more detail. Firstly, the GFV does exactly what it says. It guarantees the minimum your car will be worth at the end of your finance term, so it provides a level of protection against unexpected depreciation. For example, if used car values drop unexpectedly and your vehicle is no longer worth as much as you'd expected, you can still hand it back to the finance company with nothing more to pay, even if it's actually worth much less than the GFV. While the monthly payments might be lower, the total cost of finance and APR can be higher than personal loans or HP. You won't own the vehicle unless you decide to make the optional final payment to keep your vehicle at the end of your plan. Finally, PCP plans are designed for people who like to replace their vehicle regularly. So, to sum up a personal contract plan, you pay a deposit. You pay equal monthly payments, calculated as the difference between new car cost, less deposit, and the Guaranteed Future Value, plus interest. You choose your finance term, usually 1 to 4 years. At the end, you choose to pay your optional final payment and keep the car, or to hand it back, or to trade it in as part of a deposit for a new vehicle. It's that simple.